the MPC decided to increase the policy repo rate by 50 basis points to 5.9% and to remain focused on withdrawal of accommodation while supporting growth. Now, let me step back a little and elaborate on our monetary policy stance. Monetary policy had moved from neutral to accommodative stance in June 2019. At that time, repo rate was 5.75%, headline CPI inflation was hovering around 3% and was expected to be in the range of 3.4 to 3.7% in the second half of 1920, and liquidity was in deficit mode with an average daily injection of 0.3 lakh crore in May 2009 under the Liquidity Adjustment Facility, that is LAF. Today, inflation is hovering around 7% and we expect it to remain elevated at around 6% in the second half of this year. Liquidity remains surplus with average daily net absorption of rupees 1.1 lakh crore under the LAF in September 2022, and this is up to 28th September. As government expenditure picks up on the back of high GST and direct tax collections, the system liquidity will go up further. Thus, even as the nominal policy repo rate has been raised by 190 basis points so far, including the increase that we have effected today, the policy rate adjusted for inflation trails the 2019 level. The overall monetary and liquidity conditions therefore still remain accommodative, and hence the MPC decided to remain focused on withdrawal of accommodation. I would now like to provide our assessment of growth and inflation, and first let me take up growth. Real GDP grew by 13.5% year on year in the first quarter of this year, this financial year, that is 2022-23. Now this surpassed the pre-pandemic level by 3.8%. This was led by robust growth in private consumption and investment demand. High frequency data for the second quarter indicate that economic activity remains resilient. Private consumption has been holding up. There is sustained revival in urban demand, which should get a further impetus from the unfettered celebration of upcoming festivals after 2.5 years of living with the COVID-19 pandemic. Rural demand is also gaining gradually. Investment demand is picking up and is evident from the robust growth of domestic production and import of capital goods in July and August. Bank credit has grown at an accelerated pace of 16.2% year on year as on September 9th, as against 6.7% during the corresponding period of last year. Total flow of financial resources from banks and non-banks to the commercial sector has improved significantly to rupees 9.3 lakh crore in this financial year so far, that is up to September 9th, from 1.7 lakh crore in the corresponding period of last year. So this year the flow of commercial resources is 9.3 lakh crore compared to last year figure of 1.7 lakh crore for the same period. According to the RBI survey, seasonally adjusted capacity utilization of the manufacturing sector improved from 73% in the fourth quarter of 21-22 to 74.3% in the first quarter of 22-23, and this is in fact the highest level in 3 years. Last time I had given that the decline, I had given the unadjusted capacity utilization which had improved. That's what I had stated in the last monetary policy meeting, but I think it's always better that and that reflected the seasonal pattern. So therefore I think it is always better to look at the seasonally adjusted figures, and that is what I have attempted to provide today. Non-oil, non-gold imports remained resilient, indicating sustained revival in domestic demand. Merchandise exports growth, however, faced headwinds from unsettled external environment. In the supply side, the agricultural sector remains resilient. The monsoon rainfall was 7% above the long period average as on 29th September. Kharif sowing was 1.7% above the normal sown area as on 23rd September. The production of Kharif food grains as per the first advance estimate is only 0.4% below the first advanced estimate of last year. The reservoir levels are at 87% of the full capacity on 29 September as against the decadal average of 77%. This augurs well for the ensuing Rabi crop. Now, we decided to provide all these numbers so that there is clear communication about where exactly we stand in the agricultural front. Industrial activity, as reflected in the growth of index of industrial production, slipped to 2.4% in July. India's manufacturing purchasing managers index, that is PMI, the manufacturing PMI, however, indicates sustained expansion at 5.2 in August. Business sentiment, as reflected in the manufacturing PMI, strengthened with the degree of optimism at its highest in 6 years. Service sector indicators point towards strong growth in July and August. Services PMI rebounded to 57.2 in August from 55.5 in July. Business confidence rose to a 51-month high. So I have first provided where we stand with regard to aggregate demand, where we stand with regard to aggregate supply, and within that I have focused on the agriculture sector, the industry sector, and the services sector indicators. Now, looking ahead, all these factors should support aggregate demand and activity. The headwinds from extended geopolitical tensions, tightening global financial conditions, and possible decline in the external component of aggregate demand can pose downside risks to growth. Taking all these factors into consideration, which I have just narrated, real GDP growth for the current financial year 2022-23 is now projected at 7%, with second quarter at 6.3%, third quarter at 4.6%, and the fourth quarter at 4.6%, with risks broadly balanced. The growth in the first quarter of next financial year, that is 23-24, is projected at 7.2%. I would now like to focus on inflation. Global geopolitical developments are weighing heavily on the domestic inflation trajectory. Inflation inched up to 7% in August from 6.7% in July. Acute imported inflation pressures felt at the beginning of the financial year have eased, but remain elevated across food and energy items. Edible oil price pressures are likely to remain contained on improved supply from key producing countries and measures taken by the government. Going forward, there could be some tapering of selling price increases on account of easing supply conditions and softening of industrial metal and crude oil prices. With services activity showing strong rebound and some improvement in pricing power, risks of higher pass-through to input costs, however, do remain. There are also upside risks to food prices. Cereal price pressures is spreading from wheat to rice due to likely lower Kharif paddy production. The lower sowing of Kharif pulses could also cause some pressures. The delayed withdrawal of monsoon and intense rain spells in various regions have already started to impact vegetable prices, especially tomatoes. These risks to food inflation could have an adverse impact on inflation expectations. The Indian basket crude oil price was around 104 barrel in the first half of this year, 22-23, and this is the actual number which has been realized. In the first half of this year, the Indian basket price was, the average was around $104 US dollars per barrel. Going forward, we are now assuming it to be $100 per barrel in the second half of this year. Taking into account these factors, the inflation projection is retained at 6.7% for the current year, with second quarter at 7.1%, third quarter at 6.5%, and fourth quarter at 5.8%, with risks evenly balanced. CPI inflation is projected to further reduce to 5% in the first quarter of next financial year, that is 23-24. The extraordinary global circumstances that caused the heightened inflationary pressures have impacted both advanced economies as well as the emerging market economies. India is, however, better placed than many of these economies. If high inflation is allowed to linger, it invariably triggers second-order effects and unsettles expectations. Therefore, monetary policy has to carry forward its calibrated action on policy rates and liquidity conditions consistent with the evolving inflation growth dynamics. It must remain alert and nimble. I would now like to focus on the liquidity and financial market conditions. During the current financial year, the weighted average call rate, that is WACR, the operating target of monetary policy, has increased cumulatively by 196 basis points, that is 196 basis points in a phased manner up to September 28th over March 22. This is in sync with our actions on the SDF and the repo rate. Consequently, interest rates across financial market spectrum have increased, though at varying degrees. Surplus liquidity in the banking system, as reflected in the average daily absorption under the liquidity adjustment facility, that is LAF, including both SDF and the VRRR auctions, moderated to 2.3 lakh crore during August to September, that is during this period of August and September up to 28th September, it moderated to 2.3 lakh crore from 3.8 lakh crore during June-July. So it was 3.8 lakh crore during June-July, and in August-September up to 28th September, the overall system liquidity has moderated to 2.3 lakh crore, and that is evident from the overall LAF position.
All right, the three major announcements from the RBI governor's monetary policy decision. Number one, a rate hike has been announced of 50 basis points. That takes the interest rate to 5.9%, which is a 3-year high. Number two, on the inflation forecast, the Reserve Bank says that inflation will remain around 6% for the rest of the year, as there are still risks to input costs, there are still risks to food prices. But the inflation forecast for the current financial year, FY 2023, has been retained at 6.7%, because the Reserve Bank said that for the first half, crude oil was at $104 per barrel, the Indian basket, but now it has come down to $100 per barrel. The third major announcement on the growth forecast, and that's a big one, because the growth forecast for the Reserve Bank has come down from 7.2% for the current financial year to 7%. So the Reserve Bank has lowered the growth forecast for the current financial year, and this was expected since the Q1 growth for this year missed the Reserve Bank's estimate. So those were the major announcements from the Reserve Bank's monetary policy.